Hi, it's Dave. In a recent conversation I had with Emmett Peppers, he mentioned the Black-Scholes formula as a way that options market makers use to price option contracts, and he thought it had some major shortcomings. After reading a bunch of articles and watching some videos on it, I wanted to discuss it further with someone, so I asked my Twitter followers for some help. Hersh Mehta reached out to me and offered to answer any questions I had, and we had a couple of offline conversations that I found helpful. So I invited him on my show so others can hear some of his thoughts and insights into stock versus options. Now, I know many here won't know a ton about options, and I think that's okay. Options is inherently more risky than holding stock because it usually deals with leverage, and it's also usually a bet on timing as well. So for most people, holding stock is probably risky enough. But for me, I'm always searching and trying to get to the essence of things. And while I've traded options on and off over the years, I wanted to look deeper and see if there are any loopholes in the system that an individual investor can take advantage of. But in order to find any loopholes, I think it's important to dive into the role of the options market maker, what they do, what are their goals, and are there any shortcomings in their strategy? I hope you enjoy this conversation. All right, today I'm joined by Hersh Mehta. He's an early Tesla investor and Model S owner and a member of the TeslaMotorClub.com forum since the end of 2012. He's worked at a high-frequency trading firm and also for Bloomberg, and now he's a research engineer for Facebook. Welcome, Hersh.
Hey Dave, it's nice to be here. I've been following your posts on TMC since 2013, and I just want to thank you for all the great work you've done over the years.
Yeah, no problem. Thanks for coming on. Appreciate it.
Yep.
Yeah, first off, I want to ask if you can share a bit about your background, how you got interested in trading, and also how you learned about the options markets.
Yeah, sure. So I've been trading since I was in high school, and throughout college, I ran a couple of investment clubs. My trading philosophy has been a mixture of fundamental and technical analysis and using option strategies as a means of modifying that philosophy. And then I started working at a HFT out of college, and that was really the key moment in my trading career. I would say that gave me insight on what the folks on the other side of my trades were doing, and it helped me gain an understanding of how both parties with their subjective beliefs can have an edge and make money on a given trade. So, and I've learned a lot during my time at an HFT, and tried to use that over the years since I've left.
Got it. So HFT is high frequency trading firm, for
Yes.
those who don't know. These are the companies that are responsible for a bulk of the trades in the market today, making oftentimes like micro transactions or just getting in between, say, stock transactions, but also, let's say, selling options to people who are buying options. I want to go into a bit like who are these market makers, what are their advantages, etc. But first off, for the beginner, let's say, who's just starting out getting exposed to options, can you explain like what is an option, like an options contract, and how is it different than just holding stock?
Sure. So at a very high level, when you buy a stock, you're buying a piece of the company, and you're buying into the future of the company, the CEO, and its operations. An option is simply a right, but not an obligation to buy or sell the underlying stock at a predetermined price. The key difference here is that you can view options like insurance, and you're paying a premium in the form of the option price for that right. And the main takeaway there is you're paying for time, and you're paying for volatility as part of this premium.
So what do you mean by you're paying for time and volatility? Like, what does that mean for the beginner, let's say, who doesn't really understand options right now?
Sure. So I think it's best explained through an example, right? Say you have Tesla stock, and Tesla stock trades at $600 a share. When you look at a Tesla stock option, let's say for $575 a share, This is a option that allows you to purchase 100 shares of Tesla at $575. Now, it has an intrinsic value of $25 because the market is the share price is $25 more than 525, right? It's 600. However, on top of that, there's what is known as extrinsic value. So if you go out and you buy this option in the market, you will pay more than $25 for it. How much more you pay is determined by a number of factors. The primary factor is time. How long is this option valid for? So if you go 1 month out into the future and you say, I want the right to purchase Tesla shares at $575 next month, I'll pay some amount of premium for this. If I go out and say I want the right to purchase 100 shares at 575 a year from now, I will pay more premium. And the rationale behind this is that there's more uncertainty with time. And so you're paying a higher premium, or think of it like an insurance premium for that longer time horizon.
Okay, got it. All right, so I know like for a lot of people, they look at options or they hear about options, they get scared. They hear horror stories of people losing all their money. But I want to kind of help people unpack kind of what are the risks involved. Let's look at it more objectively. Let's say for an option call, so you're bidding, let's say you're buying the right to buy a stock at a certain price in the future. And let's say it's, higher than the current price. Like what are the main risks that, let's say, people should be aware of when buying an option call?
Sure. So I think the main risk to be aware of in the scenario you described is if the stock doesn't go above the price for which you're buying the call, that option can go to zero. And there are a total of 5 different parameters when it comes to pricing an option, but the most important parameters are the duration to expiry. So as that option gets closer and closer to expiry, it'll go to zero faster and faster if it remains out of the money. And the second parameter is volatility, so of the underlying stock. So if, for example, Tesla is having extremely volatile days, that option might still retain some of its premium, even though it's far out of the money. But as soon as that volatility dampens, it will get crushed in terms of the price. And so these are two, I would say, primary risks to be aware of when buying out of the money call options.
Mm-hmm. Awesome. So I'm trying to do a deep dive into understanding who these market makers are, and kind of how they're making money, like what's the mindset of these market makers. And I mean, the reason why I think it's important, I mean, some people might say like, hey, I don't need to know about, who's selling me these options. They're just a lotto ticket to, if some stock shoots up, I just want to, make money off of this thing in a short term. And I understand that mentality, but I also see this other side where, let's say you're dealing with a large amount of money, or let's say you're just very risk adverse, or you want to understand what you're doing. You want to understand like who's selling you this option contract, how are they making money, what's the dynamics on the other side. So I want to ask you, what can you share about, let's say, because you've worked at, high frequency trading company. I know you've had some contacts with people in the money market or the market maker, scene there. What's their role in terms of how they're making money? What's their model? And can you compare how they make money with stocks versus how they make money with options?
Yeah, sure. So market makers are basically, at a very high level, the people you trade against. They're, as the name implies, they make the market. They provide both a price at which they're willing to purchase something and a price at which they're willing to sell you something. And they have a couple of different ways in which they make money. The market making business is primarily controlled by I would say in the equity options business 4 or 5 different companies, and these companies have contracts set up with the exchanges on which they trade. So where the exchange, because they provide liquidity, they're willing to take on a trade that somebody can come and trade against. Like they can sell at a price that the market maker wants or buy at the price the market maker wants. They're taking on risk and they're providing liquidity, which attracts buyers and sellers to these exchanges. So in return for providing this liquidity, the exchanges will offer them some rebates, some benefits, and this is one source of revenue. Historically, I would say probably before 2010, their primary source of revenue was by taking advantage of the bid and ask spread. So this is the difference between the price at which they're willing to sell you something and the price at which they're willing to buy the same thing from you, right? And what they're doing is they're taking that difference and they're trying to pocket the difference by buying from a person at one venue and selling that same product to another person at a different venue. And this is a strategy that stems from the equities space. So before the advent of electronic trading, you didn't have stocks trading up to decimal points. They traded in fractions of dollars, so 1/8, 1/4, 1/16, and the market makers would pocket that 1/8 of a cent on every trade, and that same concept carries over to the equity options market. So they're trying to basically do lots and lots of these transactions, pocket these very small differences, and basically make a lot of money doing it. Yeah.
Mm-hmm. Cool. I'm wondering, let's dive a little deeper and let's say, how do these market makers price? How do they price an option? So let's say they're selling someone a Tesla 800 strike call, let's say for 3 months down the road or something. How are these market makers able to know what's the optimal price to price the option? And then I guess a follow-up question is, what if the trade goes bad for them? Like, Tesla starts ramping up, like what are they doing? I guess more specifically, what's their strategy after they sell you the option? What are they doing next?
Sure. Yeah. So it's important to keep in mind the timescales that a market maker operates in when having that conversation. A market maker is not in the business of taking on a directional bet, right? They are not going to say the price of Tesla or any share is going to go up or down. That's not how they make money. They are using what is known as the Black-Scholes model at its very core for pricing these options. Now, the Black-Scholes model is this complicated math formula. It's not really important how to go into detail on that. Suffice it to say that the most important variable that is unknown to an options market maker inside of this formula is the implied volatility of the option. And so they are basically trying to understand what the volatility of this particular stock is going to look like based on historical volatility and predicting future volatility, and take advantage of imperfections in that volatility surface. Now, when they sell you when a market maker sells you an option, they are generally hedging out their risk by going to the market and employing different strategies, maybe buying other different types of options from different market makers or buying stock or something like this. The key thing there is to know that they're in the business of volume, right? And so they're playing a purely statistical game, right? They're willing to lose money, sometimes lots and lots of money on individual transactions, because they know that when they do these transactions, hundreds of thousands or millions of times in a day, um, they're gonna over the long run make a lot more money than they'll ever lose. And they so for them it's a business of volume and a business of statistics, not a business of any one individual product that they're selling.
Got it. I'm wondering, like, how do you think it's possible, if it's possible, to tilt the odds in your favor when you're trading options? Like, obviously these market makers have statistical models, so they're mapping out everything and they're making a lot of money, so they're doing something right. But like, is there a way for an individual investor, you think, to go in and somehow find an edge, find their place in the options market to actually make money on a consistent basis?
Yeah, I mean, I think the advantage that an individual investor can have in the options world is comes from the fact that they understand the underlying fundamentals of the business, and so this gives them an edge because they might have a personal understanding of the price distribution of that underlying stock that differs materially from what the options market is pricing in, right? So to give you a concrete example, right? Let's say I understand the business of Tesla very well, and the options market is looking at Tesla and a thousand other companies that are in the same space in the S&P 500 or in the Nasdaq, and using that as a basis for pricing options around Tesla. Now, if I have an understanding of the business and I have a belief that Tesla's stock price will move dramatically in a certain direction that is not being properly priced, I then have that advantage where I can go in, I can trade options, I can use my belief, I can act on them and potentially make significant returns.
Awesome. What kind of resources would you suggest for those people who are wanting to learn more about options? Let's say they've heard about it, they're intrigued a bit, they might be scared of it, but they're saying, hey, I want to learn at least more about what all this is about. Where would you suggest them to go?
Sure. I think there's a lot of different resources out there. There's a ton of books. I think what I found to be the most useful for me is the power of Google and the power of hands-on learning, right? Going through Wikipedia and Investopedia and a bunch of Google articles, searches on options pricing, and then putting my own money at stake and trading and seeing how the markets react to my trades, I think it is the best way to learn about the options market.
Awesome. Yeah, this is I think, super helpful conversation, Hersh. I want to thank you. Before we close, I know we've been, part of this TeslaMotorsClub.com forum since, the early days, I guess 2012 or 2013. We've seen Tesla go through lots of ups and downs. I know you were an early Model S owner, right?
Yep.
I remember you wrote something about how the deposit you put in, or something about the money you put in, if you sold Tesla stock back then or half your
Yeah.
stock, and if you would have kept it, it'd been worth a lot. But I mean, I don't know if you're able to share, but can you at least share what you can about that?
Yeah, sure. So, I mean, I took my first test drive of Model S back in the December of 2012. This was right around the time that Tesla was on the verge of bankruptcy, unknown to us until much later. And I immediately fell in love with the car, and this was the first car that like my parents and I all sat in, and we just fell in love with. And so we put down a deposit, and there was a 4 month waiting period during which like before you got delivery, right? So I took whatever money I had for that I was going to spend on the vehicle, and I bought some Tesla stock with it. So I think I was going to finance like 95% of the car and put down cash for about 5% or 10% of the purchase. I went ahead. I had about twice as much money lying around in my bank account. I just put it all into Tesla stock. Um, and then I think I bought about like $10,000 worth of Tesla shares around 32 or $34 pre-split. And come April, I had to sell half of them because the car was ready to be delivered. So, so that was probably my biggest regret is selling half that $5,000 of Tesla shares back then, which I think in today's prices would be worth about like $500,000 had I just held on.
Yeah, yeah,
So yeah, I guess that was a lesson learned very in a very difficult way, but
yeah,
you live and you learn.
yeah. I think back then it was like almost unfathomable by most people that Tesla, a $5,000 investment in their stock could be worth 500,000 today. It's just like
Yeah.
it's not even that long ago, just like
Yeah.
8 years ago or 7 years ago. It's crazy. Did you manage to keep at least some of that stock that you bought back then?
Yeah, yeah. So I've been actively trading around my core stock position. So I have some shares that are in my main trading account as well as in my retirement account. But I've been actively trading around them, sometimes using the ARK ETFs as a deleveraging scheme, so that if I want to de-risk some of my position, then moving that money into ARK. And then other times when options prices or stock prices are severely deflated, then using options as a strategy for increasing my exposure to Tesla.
Hmm. I mean, do you find like timing and using options? Do you find it worth it in your experience versus? I mean, especially this past year with Tesla, if you were either able to catch the big move, let's say with leaps, long dated, let's say options, or you just held stock, like it seems like that would be perhaps more a higher probability that you'd have a big gain versus just trading in and out. Let's say, when you think it's high or low, like, I mean, what's your take on that? Like, just holding on to a company just with, let's say, pure stock versus, you know, guessing, let's say more short term, let's say every, a couple months out, or versus like long dated options. Like, what's your take on how you compare those three in your mind?
Yeah, I mean, I'll say that like when you have so let me preface this entire conversation by saying 2020 was an anomaly, right? In every sense of the term, whether it be specific to to Tesla stock price, to COVID, to the entirety of the market, or anything else, right? It's a complete anomaly. I don't think anybody ever dreamt that Tesla would be trading at $650 after a 5-to-1 split, right? If you go back 12 months, I don't think anybody could have thought that it would have gone up that fast, that much. Um, so I think in general, buying and holding on to companies that you are um, that you believe in terms of the management, their execution, and their road plan, the market that they're disrupting. I think over the long run, that wins out every time. I think even when you're comparing it to say getting in and out or doing leaps, I think uh, on average, you're going to make more money just buying and holding the stock for a very long time. That being said, I think each of those, like active trading and buying call options, whether they be short dated out for a few months or longer dated out, say 12 to 24 months, I think they do have their place as a strategy, as a augmentation strategy to your core holdings, right? So they can help you get a slight additional edge when you think that the markets are not pricing in what you believe is going to happen, right? When your internal probability function deviates substantially from the market, you can definitely get an edge. But I would say that you have to be very selective in doing that. And if you try to do it on a daily basis, day in and day out, like over the long run, the person that just bought and held is probably going to win out.
Sure. Do you trade most of your options in like a tax deferred or non-taxable account,
I
or do you have
trade
both?
through a LLC that I have. So
Got it.
the rules and regulations there are very different than on an individual trader. And I think that works in sort of my benefit. If I was trading sort of on a taxable account, right? So if I had to pay short-term capital gains tax, I think that would
Hmm.
be a pretty big hit, and it would make getting that edge even more difficult.
Yeah.
So for folks that don't have LLCs for them, I would say an IRA or a tax deferred vehicle of that sort is
Yeah.
probably going to be the right place for trading.
So how does the IRA like help you to not or defer, let's say, short-term, taxes? Or
Yeah, so I mean,
not an IRA, but LLC. I don't know if I said,
yeah,
yeah,
just
IRA, yeah,
um,
LLC.
yeah. So I mean, if you basically the difference there is that you're taxed at a fixed. So the way my LLC is structured, I'm taxed at a fixed tax bracket of 20%, and I'm able to market my P&L at the end of the year. So
Got it.
whatever my portfolio is on December 31st at market close, that's my portfolio, and I pay taxes on that at a fixed 20%. Right now, especially like if you're living in say California or something, you're not under sort of an LLC and you're trading under your own name, you're going to end up paying short-term capital gains tax on any transaction you do that's been less than 1 year in duration.
Mm,
So most options fall into that bucket, right?
yeah.
And so short-term capital gains tax, I mean, depending on your tax bracket, can be a substantial amount of your profits, right? Like almost close to 50% in a state like California
Yeah.
versus 20%. So that's a pretty big difference
Yeah.
to
Yeah.
to give up.
Definitely. Yeah. I mean, taxes are huge. And is there a reason why you don't trade more in your like a IRA or something?
Um, well, I've tried to treat my IRA as more of a conservative play. So I'm fairly young. I know that I can take risks with the money I have, and keep my IRA in more of a conservative manner, such
Got it.
that like if you know I do something wrong and I make a mistake,
Yeah.
it doesn't affect my
Mm,
retirement plans.
got it.
So I definitely like in my IRA, I just I'll just buy stock and I'll just hold it, and I'll buy stock in companies that I don't have to worry about for 5 or 10 or 20 years. So I'll buy a lot of ETFs, I'll buy a lot of stock, and I will sometimes not log into it for months on end.
Yeah. Got it. Awesome. Hersh, man, nice chatting, and yeah, good to meet with you and to get to know you a bit. And I appreciate it. I'm sure all my viewers appreciate it as well. So thanks a lot.
Yeah, hey, yeah, thanks a lot for having me. It was great to be here.
Awesome. Talk to you later. All right, I hope you enjoyed that conversation. This week, I'm going to be joined by Gally Russell of Hyperchange, and we're going to be talking about whether or not Tesla should invest into Bitcoin with their cash reserves. Also, I'll be joined by Ross Gerber, who's active on Twitter and also is a Tesla investor. And we're going to be having a conversation about investing, Tesla, Bitcoin, and other topics as well. All right, if this video has been helpful, please like it and also consider subscribing to my channel. We're looking at investment topics through different angles, trying to poke and trying to look beneath the surface of things. All my videos are also available as a podcast. Just search for Dave Lee on investing in your favorite podcast player. I'm also on Twitter, and my handle there is HeyDave7. We'll see you in my next video. Thanks.